This tutorial will teach you about the different external sources of finance. External sources of finance are broken down into two categories, that is, debt and equity. Debt as a source of finance is split into either short-term borrowing, meaning it has to be paid within 2 years, or long-term borrowing, which means it has to be paid in a period greater than 2 years. The short-term borrowing sources of finance in the HSC Business Studies syllabus are overdrafts, commercial bills, and factoring. An overdraft is the ability for a business to write a check for money than they have. This is an agreement between the bank and the business. The bank will charge interest at a specified rate, set a limit on the amount being borrowed, and also will set a time period for when the owed amount must be paid by. The interest rates charged by banks is usually high, similar to credit cards. Commercial bills are a type of bills of exchange, which are issued by financial institutions other than banks. Commercial bills are given for large amounts of money, for a period of between 90 and 180 days. The business borrowing the money receives the funds and then agrees to pay the amount borrowed, as well as interest at the specified time. Factoring allows a business to receive funds immediately by selling their accounts receivable at a discounted price to factoring businesses. The business will receive up to 90% of the accounts receivable sold. The business cash flow and gearing level will be increased as they will have immediate access to funds. The long-term borrowing sources of debt finance in the HSC Business Studies syllabus are mortgages, debentures, unsecured notes, and leasing. Mortgages are loans secured by the property of the business. Once the property is mortgaged, it cannot be sold or used as a security for further borrowing until the mortgage has been repaid. A debenture is used by businesses to borrow funds at a fixed rate of interest and for a fixed time. Debentures are issued by the public and are not secured to property. Unsecured notes are loans for a set period of time. They are not secured to any assets like mortgages. Therefore, they present the most risk for investors. For this reason, unsecured notes carry a higher interest rate than a secured note. Leasing is the payment for the use of equipment that is owned by another party. This allows a business to use equipment without large capital outlay. Equity is also split into two parts, ordinary shares and private equity. Ordinary shares are broken down into new issues, rights issues, placements, and share purchase plans. A new issue is a security that has been sold for the first time on the public market. A rights issue is the privilege granted to shareholders to buy new shares in the same company. Placements are the allocation of shares directly from the company to investors. Share purchase plans give existing stakeholders the option to purchase more shares at a discounted price. Private equity is the money invested in a company not listed on the Australian Securities Exchange. For more information, visit teachmetoday.net.